Hi, Assalamualaikum. We are from class AC40. We presented chapter 23 of cash balance. My name is Nur Atifa binti Khairul Anwar. Today I'll be talking about learning objective 1, how some mistakes or frauds related to cash might not show up during a bank reconciliation, but can be found in the audit of the sales and collection cycle. Let's look at the two examples. Failure to be a customer. Sometimes a company forget to send invoice to a customer. If we don't bill them, we don't get paid. Since there was no money expected, it won't show as missing in the bank reconciliation. But this mistake can be found when we look at closely at the sales records and see that a sale happened, but no invoice was sent. Next is embezzlement of cash receipt. This is when someone steals the money that a customer pays. To hide it, they might change the records, like giving a credit adjustment to make it look like the customer doesn't owe anything. This kind of fraud also won't show in the bank reconciliation because everything seems to match on the surface. But when we audit of the sales and the collection cycle, we might notice that the customer actually paid but the money didn't go to the bank. Let's continue discuss three examples. Firstly is duplicate payments. This happens when a company pays the same invoice more than once. It might be an error between departments or system. The bank only shows the money left the account. It won't tell us it was a duplicate. We can find this mistake by comparing all invoices with payments. Next is improper payment of personal expenses. Sometimes an employee may include personal expenses in their report. This could be genuine mistake or intentional. Again, the bank would say who the payment was really for. Auditing the payment records help us to spot these problems. Next is payment for raw materials not received in this case. The company pays for goods but never received them. This might be due to poor tracking or even fraud. The bank shows the money went out, but unless we check the delivery record, we won't know nothing was delivered, which means the payment appears in the bank but the company got nothing in return. Let's now look at two more examples of cash-related mistakes that are not easy to see in bank reconciliation but can be found in specific audit cycles. Firstly is payment to employee for hours not worked. Sometimes employee may claim more hours than they actually work. They might be paid for sick days not taken, overtime not done, or shift they skip. The bank will just show a payment, but it won't say if the hours were real. To catch this, we need to audit the payroll of and personal cycle, checking time records, schedules, and approvals. Lastly is payment of excessive interest to a related party. Related party could be someone like company owner or family member. They might be charged a very high interest rate on the loan to the company. This is a way to take money out unfairly. The bank only shows the payment, not whether it was fair or legal. This can be found by auditing the capital acquisition and repayment cycle, where we can check loan agreements and interest rates. This diagram shows that cash in the bank doesn't stand alone. It's all connected to all part of the business. Whether we are making sales, paying suppliers, giving out salaries, or dealing with loans and investors. Every activity affects the cash balance. That's why in audit, we can't just look at the bank. We have to understand how each business cycle adds to or takes away from cash. I will explain what the diagram is about. Let's start in the middle. Cash in bank has a beginning balance and ending balance. This balance change money flows in and out. Sales and collection cycle. This cycle explains how the company receives cash. When the company makes sales, customers are billed and owe money, which is recorded as account receivable. Once customers make their payment, the company receives cash. Sometimes discounts are given, which can reduce the total amount collected. Next is acquisition and payment cycle. This cycle shows how the company spends cash on goods and service. The business may purchase items on credit, creating account payable. When the company pays the supplier, cash flows out of the bank account. Next is payroll and personal cycle. This cycle involves paying employees. The company regularly pay wages, bonus, and payroll tax. These outgoing payments reduce the company's available cash. Lastly is capital acquisition and repayment cycle. This cycle covers how the company raise or return funds. The company can bring in cash by issuing stock or taking loans. On the other hand, cash is spent where it repays loans, redeems stock, or pay dividends to shareholders. Now let's talk about certain cash-related mistakes that are normally discovered during a bank reconciliation. Bank reconciliation is where we match the company cash record with the actual bank statement to make sure they are in agreement. One common mistake is the failure to include a check on the outstanding checklist. This means the company has already written the recorded the check in their books, but it hasn't yet been processed by the bank. If this check is left off the list of out of outstanding items, it causes the reconciliation to be incorrect. The records might show a lower bank balance than what is actually true because they forgot to show that the check is still waiting to clear. The second mistake is recording cash in the wrong period. For example, if a check is received a few days after the balance sheet date, but is entered into the book as if it was received before year end, it leads to the overstated cash balance. This gives a false picture of the company financial position at year end. This kind of error don't usually show up in the other audits, but they can be identified when doing a proper bank reconciliation, which is why this step is so important in the audit process. Now let's look at two more types of misstatements that are often found during the bank reconciliation process. The first one is about deposit recorded near at the end of year. Sometimes a company deposit money at the end of December and record it correctly in their books. But if the deposit also reached the bank in December, it should appear on the bank statement. However, some companies still list it as a deposit in transit, which is something that hasn't hit the bank yet. These mistakes can make the reconciliation incorrect and may confuse the timing of cash receipts. The second misstatement happens because when the bank makes a payment on a note payable like a loan and takes the money straight from the account, but the companies forget to record this payment in their own books. This causes a difference between the bank's records and the company's records because the bank balance is lower, but the company hasn't shown the cash going out yet. This example shows how important it is to carefully compare the bank statement with the company's record to find any missing or wrongly recorded transaction. That's all for me. Next, I will pass to the next presenter.
Assalamualaikum and hi. My name is Nora Ain Izzati binti Muhammad Adli and I will continue about the learning objective 2, which is to identify the major types of cash accounts maintained by business entities. So, business handles various types of cash transactions every day, like paying employees, buying supplies, and collecting money from their customer. To manage this efficiently and securely, companies set up different types of cash accounts, each with its specific purpose. So this will help to improve internal control, simplify the bookkeeping, also to monitor the cash flow and to prevent fraud or errors. Basically, we have 5 types of cash accounts, which is the first one we have is general cash account, second is impress payroll account, third branch bank account, and fourth one is impress petty cash fund, and the last one is cash equivalent. So I will further explain about these types of cash account in the next slide. The first one we have is general cash account, which is general cash account is the main bank account of a business. It is the central account through which all cash receipt, we call it inflows, and all cash disbursement, we call it outflows, are recorded. This means every time the company receives money, for example, from the customer, or pay money to the supplier, the transactions are processed through this account. For example, if a business receives 5,000 ringgit Malaysia from a customer and then they pay 2,000 ringgit Malaysia for office rent, both transactions go through the general cash accounts. And the second is impress payroll account, which is a separate bank account that the company use only for payroll purposes, such as for paying employee salary. It operates on a fixed balance basis, meaning that the company transfers just enough money to cover for each payroll cycle, which is done by weekly or monthly. The main purpose is to improve the internal control over payroll disbursement as it separates the salary payments from other cash transactions. For example, if a company's total monthly payroll is 100,000 ringgit Malaysia, it transfers exactly that amount from the general cash account to the impress payroll account before the payday. This limits the risk of unauthorized or excess salary payments. And the third one we have is branch bank account. This is a bank account opened by a branch office of the company. For example, we have a factory or sales office in another state. It helps in handling transactions locally instead of always using the main or headquarters bank account. It is also useful to build good banking relationships in local area, which can help the company with services like loans or faster processing. At the same time, it also helps to centralize operations by linking all branch accounts back to the main system. For example, we have a company which is the HQ in Kuala Lumpur but opens a branch bank account in the Penang. So this allows the Penang branch to handle its own payment such as utilities or transport without waiting for HQ approval for each time. And then the fourth one we have is Impress Petty Cash Fund. This is not a bank account, which is it is a small amount of actual cash kept in the office, usually in a locker drawer or in the box. So it is used for small or urgent expenses like buying stationeries or paying the Grab delivery charge. The amount is preset, for example, like 300 or 200 ringgit Malaysia. It is reimbursed once or twice in a month, meaning when the fund is running low, it is top up from the main cash account. For example, if the company or office use 30 ringgit Malaysia from the petty cash box to buy the printed ink, at the end of the week, you must submit the receipt and 30 ringgit is added back to keep the fund full at 300 ringgit. For the last one is cash equivalents. These are short-term, which is very liquid investment, which means they can easily and quickly be turned into cash. The company can invest extra or idle cash in things like time deposit, certificate of deposit, or money market funds, which is unit trust. But these are considered cash only if they can be converted to cash quickly, usually within 3 months. For example, the company puts the extra cash like 100,000 ringgit Malaysia in a 30-day fixed deposit. Since the money can be withdrawn quickly and easily if it's needed, can be classified as a cash equivalent. So let me explain in this slide, which is the diagram shows how the general cash account is connected to other types of cash accounts in a business. At the center, we have the general cash account. This is the main account where most of the company's money flows in and out. From this main account, the company transfers money to 4 other types of cash accounts. The first one, we have branch bank account. This is for company branches in other locations. Money is sent from the general account to the branch account so that the branch can handle its own payments. Second is impress payroll account. This account is used just for paying employee salary. A fixed amount of money is transferred into this account every month from the general cash accounts. And then the third one is Impress Petty Cash Fund. This is a small cash fund for daily or minor expenses like office supplies or delivery charge. The fund is top up using money from the general account. Then we have cash equivalents, which is if the company has extra cash, it may invest in the short term, such as safe investment like fixed deposit or money market funds. These are called cash equivalents and they can be quickly turned back into cash. To sum up, this diagram shows how the general cash account is the main source of money and how it supports other accounts that serve different purposes. That's all from me. I pass to the next presenter. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Fatimah binti Alim. So let's begin with phase 1 of audit process for the general cash account. The phase all about planning and risk assessment, essentially laying down groundwork before performing any test. The first step in phase 1 is to identify client businesses that could affect the cash balance. Businesses are internal or any internal or external factor that could lead to material misstatement in the financial statement. For example, a company with weak internal control over cash handling is at higher risk of thief. A business that handle cash on behalf of other, like law firm or real estate agent, has additional responsibility which increase the risk of management. The third one is a poor cash management policy, such as not spreading duty or failing to reconcile account regularly. Also raise the red flags. As auditor, we need to understand the nature of the client operation, which is their banking relationship and any user cash activity that might indicate the potential issue. So next, we need to set the tolerable misstatement and assess inherent risk for the cash account. Tolerable misstatement is the maximum error we are willing to accept in the account without requiring a financial statement adjustment. Although the ending balance of cash may not seem large in some company, the volume of transactions affecting cash, such as receipt, payment, transfer, is usually high, which is that make a cash high risk account. Because of its susceptibility to the thief, a fraud or simple error, cash inherently carries a high level of risk, especially in the relation of 3 key audit exception, which is for the existence, because is the cash actually there? However, for the completeness, cash transactions are recorded. And the last one is accuracy, which is other amount correct. So, as a result, even minor control failure can lead to material misstatement. So next, once inherent risk is assessed, we move on to evaluating the control risk. That is the risk that a material misstatement could occur and not prevented to or detected by the client internal control. There are two major areas we look at control risk. So the first area involves control over the transaction cycle that affect cash. This include the first one is the sale and collection cycle, which is govern how cash is received from customer. The second one is the acquisition and payment cycle, which is covering how the company pays supplier and bills. And the third one is the payroll cycle, related to employee compensation. So if internal control in this area are strong, for example, if duty are well separated and approval are required, then control risk is low, and we can reduce the extent of our audit testing. So the second area of control risk relates to the independent preparation of monthly bank reconciliation. This one is the most important control over cash. A bank reconciliation compare the cash balance per the company book with the cash balance on the balance statement. Any timing difference, such as outstanding checks or deposit in transit, are identified and explained. Ideally, this reconciliation should be performed monthly by someone independent from the person who handle cash or record transaction, and should be reviewed promptly by qualified supervisor or management. If the process is displayed working effectively, we can be confident that any error or irregularities in the cash account will be caught quickly. If it's not done properly or skipped altogether, it significantly increases the risk of fraud, misstatement, and would prompt us to expand our audit procedure. To summarize, phase 1 is all about understanding the client and their risk. After we planning and risk assessment, we move to the phase 2, which is where we perform tests of control and subtlety theft of transaction. Here, the goal is to verify the control we assess in phase 1 are actually working effectively. For example, if company claims to have strong segregation of duty, we will test that by observing whether different employees are handling cash receipt versus recording them in the system. At the same time, we conduct subtlety tests, which mean examining actual cash transaction like deposit and payment. We check supporting documents such as bank deposit slip, invoice and payment voucher to confirm that each transaction is valid, authorized and accurately recorded. So welcome to the phase 3 of audit process for the general cash account, and in this phase we go beyond evaluating internal control. Now we focus on actually testing the account balance through the two main components. First, we apply analytical procedure, and second, we design and perform tests of detail. Analytical procedure help us spot red flag or unusual pattern in cash activity, while detail testing ensure the accuracy, completeness and legitimacy of the recorded cash balance. So let's go through this step by step. Let's begin the analytical procedure. This procedure involves evaluating relationship and trend in financial data to identify any inconsistency. For example, we might compare the cash balance at year end with prior years. If there is a sudden drop or increase that isn't explained by operation, erase question, or we might calculate ratios such as cash to current liability ratio or compare cash collection to sale revenue. This comparison can reveal issues like possible understatement of liability, delay in recording payment, or even fictitious cash receipt. When we find any usable fluctuation, we follow up with more detailed testing or to investigate the causes. After the analytical procedure, we move to the second and more intensive part, which is testing the detail of cash account balance. This began by obtaining a bank reconciliation prepared by the client. The bank reconciliation shows the difference between the cash balance in the company general ledger and shown on the bank statement. So our job is to verify the accuracy of this reconciliation by checking the math, ensuring all outstanding check and deposit in transit are properly listed, and the last one is confirming this reconciling item actually exists. Under cash balance related audit objective, there are 5, which is for the first one is accuracy, the second one is completeness, the third one is cut off, the fourth one is data tie-in, and the last one is the existence. So in this phase, our detailed testing must address 5 important balance related audit objectives. For the first one, detail tie-in. We make sure the amount shown in bank reconciliation match the general ledger and is added correctly. So the second one is existent. We confirm that the cash listed on the balance sheet is real and exists at the bank, often through confirmation later. So the third one is completeness. We check all the cash account and transactions that should be recorded are actually included in the books. So fourthly is the accuracy. This ensures that the amount are free from error, both in recording and computation. So the last one is cut off. This is about timing. We make sure that cash receipt and disbursement are recorded in the correct accounting period, especially around year end.
Assalamualaikum, my name is Muhammad Faika Biarullah, and I will explain about to verify bank confirmation balance. So there is 3 main procedure to check bank balances. Imagine you are trying to confirm your friend's wallet really has let's say 500 ringgit. Auditors also do the same with a company's bank balance. They don't just trust the amount on paper. They use bank confirmation. Auditor ask the bank directly, hey, how much money does this client really have? Like calling your friend's bank to confirm the wallet has 500 ringgit. Secondly, bank reconciliation. Auditor checks if the company has done a proper match between what the bank says versus what their own accounting record says. Like comparing your wallet's cash with your notebook to see if you forgot to write something. Lastly, cut off bank statement. Auditor get a mini bank statement for early January if the year end is December 31 to confirm late deposit or checks. This proof if any last minute entries were real or fake. So firstly, for bank confirmation, why bother? Even though not always required, most auditors still ask the bank for direct confirmation. Why? Because it is a solid proof. They can confirm not just balances but loans, overdraft or restriction. Simple analogy, if your friend says I've got 500 and you ask the bank directly, you will know for sure. So it is the same logic. If the auditor asks the client's company really have 500,000 ringgit, so the bank will confirm it with you. So for the second point, cut off bank statement. What's the point of that? Let's say the company claims they have received 50,000 ringgit on December 31 if they close their account on 31st December. But you check the January bank statement and the money only arrived on January 3rd. So you cannot count in the 31st December. Its purpose is to make sure late December transaction or March transaction are valid. Avoid situation where they try to make the account look better than it really is. For the last point, on how to check the bank reconciliation. Auditor double check if the bank reconciliation is correct. Does the math add up? It is a basic calculator stuff. You need to add everything in the account. Are the checks really outstanding or they haven't been cashed yet? Or are the deposit in transit really in transit? Or it's just a fake deposit? So imagine if your friend says, I paid out my rent on December 30, but you see the bank did not deduct anything. It is suspicious, right? So it is the same with auditor. If the client say that they have already paid, but the bank still did not detect any movement, so it is fake, right? So lastly, I will explain how everything connect. Imagine that cash in the bank is like a math equation. So it is starting cash plus money in minus money out. So it is equal to ending cash. To audit this, auditor have their own test control. Example, are the system working? It is test of control for transaction and test of control for bank reconciliation. Secondly, they test transaction. Are individual payments or receipts are real? It is substantive test of transaction. Thirdly, they do analysis. Does this amount make sense? Analytical procedure. Finally, they test the ending bank balance directly. Test of detailed balances. This is the most important. So for thus they don't just look at the ending number. The auditor follow the flow of cash step by step to make sure it all makes sense. Thank you. That's all from me.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Fariha binti Muhammad Nasir. So next I'm going to explain about the learning objective 4, which is when to recognize to extend audit test of the general cash account to test further for material fraud. So firstly, fraud oriented procedure. So the auditor must extend the procedures in the audit of the year-end cash to determine the possibility of a material fraud when there are inadequate internal controls, especially the improper segregation of duties between the handling of cash and the recording of cash transactions in the accounting records, and the lack of an independently prepared monthly bank reconciliation. Auditors should consider things such as the nature of the deficiencies in internal control, the type of fraud that is likely to result from the deficiencies, the potential materiality of fraud, and the audit procedures that are most effective in uncovering the fraud when they are designing the procedures. So, procedures that may uncover fraud in the cash receipts area include: first, confirmation of accounts receivable, tests performed to detect lapping, review of the general ledger entries in the cash account for unusual items, comparison of customers' orders to sales and subsequent cash receipts, and lastly, examination of approvals and supporting documentation for bad debts and sales returns and allowances. Next is extended test of the bank reconciliation. So, when the auditor believes that the year-end bank reconciliation may be intentionally misstated, it is appropriate to perform extended test of the year-end bank reconciliation. The extended procedures verify whether all transactions included in the journals for the last month of the year were correctly included in or excluded from the bank reconciliation, and verify whether all items in the bank reconciliation were correctly included. So next is the common approach by the auditors. So first, they will start with the bank reconciliation for November and compare all reconciling items with cancelled checks and other documents in the December bank statement. Second is compare all remaining cancelled checks and deposit slips in the December bank statement with the December cash disbursement and receipt journal. So the third one is trace all uncleared items in the November bank reconciliation and the December cash disbursement and receipt journal to the client's December 31st bank reconciliation to make sure they are included. And the last step is verify that all reconciling items in the December 31st bank reconciliation represent items from the November bank reconciliation and December's journals that have not yet cleared the bank. So the auditor must carry out procedures subsequent to the end of the year with the use of the bank cut-off statement. Next, I'm going to explain about the proof of cash. Auditors sometimes prepare a proof of cash when the client has material internal control witnesses in cash. So the auditor uses a proof of cash to determine whether the following are done. First is all recorded cash receipts were deposited. Second, all deposits in the bank were recorded in the accounting records. And third, all recorded cash disbursement were paid by the bank. And lastly, all amounts that were paid by the bank were recorded. So, a proof of cash includes the following reconciliation tasks. First, reconcile the balance on the bank statement with the general ledger balance at the beginning of the proof of cash period. Second, reconcile cash receipts deposited per the bank with receipts recorded in the cash receipt journal for a given period. Third, reconcile electronic payments and cancelled checks clearing the bank with those recorded in the cash disbursement journal for a given period. And lastly, reconcile the balance on the bank statement with the general ledger balance at the end of the proof of cash period. So when making a proof of cash, the auditor must combine substantive tests of transactions and tests of detailed balances. A proof of cash receipts is a test of recorded transactions, whereas a bank reconciliation is a test of the balance in cash at a point in time. A proof of cash is an excellent method of comparing recorded cash receipts and disbursement with the bank account and bank reconciliation. However, the proof of cash disbursement is not effective for discovering checks written for an improper amount, fraudulent checks or other misstatements in which the dollar amount appearing on the cash disbursement records is incorrect. Similarly, a proof of cash receipts is not useful for uncovering the theft of cash receipts or the recording and deposit of an improper amount of cash. So that's all from me.
My name is Anis Zati. I will continue presenting the topic of interbank transfer schedule. In interbank transfer schedule, the common things that happen is embezzle. Embezzle is done by an embezzler that is occasionally cover a theft of cash by practice known as kiting. Kiting is transferring money from one bank to another and incorrectly recording the transaction. A check is drawn on one bank account close to the balance sheet date. and immediately deposited in another account for the credit before the accounting period's end. This means that they taking advantage of the flows and conceal the cash shortage by exploiting the time required for a check to clear. So, how do the embezzlers do the theft of cash? Firstly, they will make sure that the check is deposited late enough to avoid its clearing the first bank before the period's end. Then, the amount of the interbank transfer is recognized as an asset in both banks if it is not recorded until after the balance sheet date. Although this fraud can be committed through many methods, the embezzlers usually involve using interbank transfer to increase the bank balance in order to make up the shortage. They also will fraudulently altering the figures on a check to increase its face value. Next, auditor can trace each accounting record for proper recording and list all interbank transfer made a few days prior to and following the balance sheet date in order to check for kiting and unintentional errors in interbank transfer recording. So, here are several things that should be audited on the interbank transfer schedule. Firstly is the accuracy of the information on the interbank transfer schedule should be verified. To ensure accuracy, the auditor should verify the cash disbursement and cash receipt records by comparing them with the disbursement and receipt information on the schedule. Also, it is important to match the dates on the schedule for receive and disburse transfer with the dates on the bank statement. Lastly, it is important to review the cash disbursement and receipt records to ensure that the schedule includes all transfers made a few days prior to and following the balance sheet date. Secondly is the interbank transfer must be recorded in both receiving and disbursing banks. The auditor must check whether both disbursement and receipt were recorded or not. If only one transaction was recorded, this could be an evidence of an attempt to conceal a cash theft. Thirdly is the date of the recording for the disbursement and receipt for each transfer must be in the same fiscal year. If a cash receipt was recorded in the current fiscal year and the disbursement in the subsequent fiscal year, it may be an attempt to cover a cash shortage. Fourthly is disbursement on the interbank transfer schedule should be correctly included in or excluded from year-end bank reconciliation as outstanding checks. The potential for kiting can be indicated by the bank reconciliations under statement of outstanding check. Last but not least is receipt on the interbank transfer schedule should be correctly included in or excluded from year-end bank reconciliation as deposit in transit. The bank reconciliation of a statement of deposit in transit could indicate the possibility of kiting. Next, I will move on to the next learning objective, which is design and perform audit test of the Impress Payroll bank account. Firstly, what is Impress Payroll bank account? Impress Payroll bank account is a separate bank account used by companies to manage payroll payments and contains funds strictly for employee payroll use. It operates on the Impress system, which means it is funded with just enough money to cover payroll expenses for a specific period. So when payroll comes due, funds are withdrawn from the Impress account rather than from the company's main account. If there are Impress payroll account and independent bank account reconciliation, the test of the payroll bank reconciliation should just take a few minutes, as usually the reconciling item for it are only outstanding check. The method used for reconciliation are identical to those outlined for general cash, with the exception that tests of the outstanding are often restricted to a reasonableness test. Extended procedures are obviously required if the controls are insufficient or if the cash balance in the general ledger does not match the bank account. That's all from me. I will pass to the next presenter.
Hi, Assalamualaikum. My name is Nur Afni. So I will continue with the petty cash. Petty cash is a small amount of cash kept on hand for paying minor expenses rather than issuing a check for every small transaction. This account is unique because although the amounts involved are often immaterial, petty cash is still subject to verification in many audits. The main reason for this scrutiny is the risk of embezzlement and the expectation from the client that all accounts, even small ones, are reviewed during an audit, even if the sums are minor. Effective internal control over petty cash starts with the use of an imprest fund, which means one individual is responsible for the fund. This person ensures that the petty cash is not mixed with other receipts and is kept separate from other business activities. Keeping the funds isolated like this helps to maintain the accountability and reduce the risk of misuse or confusion with other transactions. To safeguard the petty cash, several control measures should be in place, which is first is there should be clear limits on both the amount that can be spent from petty cash and the total fund size. Second, the type of allowable expenditures must be well defined by company policies to prevent unauthorized use. All disbursement must be approved by a responsible official by using pre-numbered petty cash forms to track each transactions. Finally, the total cash, checks, or unreimbursed vouchers in the petty cash funds should always match with the general ledger records to ensure that there is accuracy and can detect discrepancies quickly. For reimbursement procedures, when the petty cash balance gets low, a check payable to the petty cash accounts should be issued, which is from the general cash account. The reimbursement should exactly match the total of the pre-numbered vouchers collected for expenses. These vouchers must be verified by the account payable clerk and then cancelled to prevent them from being reused fraudulently. This process ensures that both transparency and control over petty cash replenishment. When auditing petty cash, the focus should be on the transaction themselves, not just the ending balance. There's a risk of improper transactions, which is like especially if the fund is frequently replenished, so even the small amount require proper oversight. For the common audit test, it depends on the assessed control risk. If the risk is low and the reimbursements are infrequent, auditor might skip detailed testing due to immateriality. However, if the testing is required, auditor typically count the petty cash balance and test one or two reimbursement transactions to verify compliance with the procedures and detect any irregularities. Okay, that's all from me and us. Thank you.